Welcome to the Gray Report. I'm your host, Spencer Gray. I'm joined by Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. If you're a multifamily investor, you're trying to get into the multifamily investing world, maybe you're kind of already doing that, you're an investor, you're in the industry. We designed the Gray Report just for you to keep you up to date on everything that's going on in the multifamily industry, real estate, and the economy. Every single day, we are searching for the latest research reports, data, articles to try to give us just a better picture on where the multifamily industry is and maybe where it's going. Therefore, we can make some even better investment decisions in the future. We've got a lot of great reports today, reports from CBRE, Newmark, Apartment List, article from the Wall Street Journal. We're going to be breaking it down, trying to filter the noise. Let's get into it. All right, everybody, thanks again and welcome to the Gray Report. But first, just a quick message from our sponsor. This episode of the Gray Report is sponsored by the Gray Fund, a stabilized multifamily investment fund sponsored by Gray Capital. It's a $100 million equity fund targeting to acquire around $300 million worth of cash flowing multifamily assets in the Midwest. We're offering bespoke return profiles, a lot of customization, a lot of different features. But the most important thing is you're going to be partnering with an experienced sponsor with experience of investing in over 10,000 apartment units, currently having over $500 million of assets under management. So if you are an accredited investor and the opportunity is only open to accredited investors, hop on over to graycapitalllc.com/grayfund. That's llc.com/grayfund. There's a quick form to fill out. Just express a certain level of interest. You're going to get sent over the full investment presentation. We're hosting a webinar next week as well, and you'll be sent the information to sign up to attend that webinar. And actually, Matt, we're going to be hosting a webinar twice a month.
Twice a month?
Twice a month. The second Saturday of every month, and then the third Tuesday. So awesome. Saturdays at 9 a.m. Eastern, and then Tuesdays, I believe, at 3 p.m. Eastern. So if you miss a webinar, we're going to be hosting additional webinars. And during those webinars, we're really going to be breaking down not only just kind of the overview, how the fund's structured, what we're targeting, the criteria. We're also going to be going into kind of what the pipeline is, giving a sneak peek of all the deals that we're looking at, deals that are under contract, because we've got over $600 million worth of just deals in the pipeline. I think we'll have submitted 3 LOIs this week on about, call it $60 million worth of assets, and then we've got 3 LOIs going out next week for about $150 million worth of assets. We've toured about 2,000 different apartment units over the last couple of weeks, walk-in units looking for deals. And the environment is still, positive. Things are moving, but we're still able to find some pretty compelling opportunities. And so if you'd like to kind of join us on this journey, find some great apartment assets, again, hop over to graycapitalllc.com/thegrayfund. All right, Matt, beyond business, have you been? And how are you feeling, most importantly?
I've been feeling good. I'm pretty energized this week. It's been an exciting week with the launch of the Gray Fund. Yeah. And I continue to get some positive news. A little bit of the anxiety that was kind of lingering last week has really kind of resolved. I think that there are some really strong signs. Retail spending was up. Yeah. I just saw last night or maybe this morning. But yeah, there's some unexpected growth and it seems like a little bit of the anxiety is starting to ease. So I think inflation's still a problem.
I think part of your lower anxiety level is the fact that you're tuned in and it's easier to kind of see past the headlines because we were just talking right before we hit the record button about quite a few articles and some videos pointing towards an upcoming housing crash. And it's good to know that, there's always, like we've said, there's always a black swan out there. There are always things that we need to be aware of. And as often as there can be positive signs, there may be something lurking out there. And when everything looks positive, it's a good time to be a little bit cautious. Yeah. But it's not a good thing to be concerned and make decisions just based on a feeling. The next step is let's actually dig into it. Let's look at the data. Yeah. Because the biggest reason I've seen people say that, okay, there's going to be a housing crash are pointing at the amount of supply that's going to be coming online over the next really 2 to 3 years. But that discussion is really absent a comparison to the demand in those markets, and also lumping in, basically looking at it from a national perspective, which again, you can see some trends and some themes, but it's, as we talk about all the time, it's really hyper local.
Yeah. Whenever we talk about supply, it's like, what is this market doing? Yeah. It's not like a bunch of apartments in Washington State is really going to affect Raleigh Durham. You know.
Yeah.
So.
Exactly. And then just one market. Then you have to look in those submarkets. There's some markets that are just lagging, and there are different positions in the economic cycle. I mean, I'm just thinking about Indianapolis, for example, where the downtown is in a recovery phase, whereas other markets like maybe the suburbs are really much more of an expansionary phase.
Yeah.
So
it is interesting to look at these numbers and how absorption continues to outpace the supply anyways. Yeah. So if those numbers were flip-flopped, then I'd be worried. But just a big number for supply without looking at absorption and without looking at the people that are going into these apartments, then it's not really, there's no context.
And looking at how our deficiency of housing units, because I think last year in 2021, we had about almost double the amount of absorption that we had new supply. So we've got some catching up to do. That's for sure. Let's just get into the first report. Is there a CBRE, Commercial Real Estate Capital Markets Q4 2022, and this is important. Just tracking capital inflows, because this is a little bit more macro, looking at least again national level. But what are people investing in, and what's the investor appetite? Maybe a little bit of insight of cap rates going up, going down. Yeah. People buying deals, doesn't seem like cap rates are going to be going up. But what's your takeaway, Matt?
I talked about context just a second ago, and this one I specifically started with this one because it provides a global, a U.S. context and the context of how different sectors are performing. It's not just multifamily, although it's definitely the star of the show when it comes to this report. Multifamily led all sectors for investment volume in the past quarter and for the year. Total U.S. CRE investment was a record $296 billion for the fourth quarter, and a record $746 billion for 2020 as a whole.
Wow.
Those are big numbers. And when you're talking about markets, LA and NYC had the highest levels of investment, but the Sun Belt led for investment growth.
Yeah.
Las Vegas is up 232%. This is for all sectors. Houston up 191%. South Florida 179% increases. Wow. Those are crazy increases. And the year over year increase for last quarter, this is for everything, between Q4 2020, Q4 2021, this is for all markets, was 90%. And it's not much different when you look at the full year.
Is that year over year?
For the full year, it's 86%, and then just for the fourth quarter, year over year, it's 90. Wow. Essentially, the same.
But
huge.
And then it gets into the base effect, because if we're comparing 2020,
I know that's
investment.
This is a story of how little investment there was in 2020, just as much as how much there was an increase.
And again, this is coming right back to what we were talking about earlier about looking, at only one piece of the data.
Exactly.
And you could look at that and make a conclusion. I wouldn't necessarily be wrong that wow, this is so frothy because there's so much money, which is 100% accurate. But looking at your year over year numbers is a little bit, you're not looking at a clear picture. It's better to look at 2019 compared to 2021.
And that's what's kind of frustrating too, at least for me now, is we were looking at pre-pandemic trends, and the farther we get away from the pre-pandemic, the more it's going to be this kind of muddy middle where these 2 years it's going to be harder to make that jump. But
absolutely. And so just looking at some of these metros, which metros are getting the most overall investment? Let's look at multifamily, though. Yeah, like you said, Las Vegas growth year over year. Yeah. 394% growth. And then, Houston, followed by South Florida, number 3 spot, 4 Orlando, 5 Baltimore, 6 San Antonio, 7 San Diego, 8 Seattle, 9 Nashville, and 10 Raleigh, Durham. Not too surprising seeing that list. Maybe
Baltimore,
the fact that Dallas,
I thought was interesting.
Yeah, Baltimore.
I haven't really read that much. We talked about the Sun Belt, but Baltimore is a clear outlier.
Yeah, I think.
And this is for investment volume too. And this is why I kind of like this chart. It's a little bit different than previous reports we had of like rent growth and absorption and vacancy and supply, which this report does touch on. But this is this is kind of really looking at how much investor attention is being paid on these specific markets and on these specific sectors. And also, if you do look at multifamily compared to these other sectors, it's a clear leader when it comes to investment volume. Its market share is 45.9%, and it's almost double the second place, which is industrial at 21.5% of market share, followed by office 18.3%, retail at 9.9%, and hotel at 5.7%. Wow. Yeah. So you can see the drop off is really right after multifamily.
Yeah, and where experienced investors are putting their chips, where they think it has legs. And I remember us saying this early on in the pandemic when it's probably like May or June, maybe even July, essentially saying that when we started seeing that we were still receiving rent and delinquency wasn't shooting up and occupancy was still strong and things were surprisingly going well, we looked around and we're like, if we can get out of this relatively unscathed, this is going to be one of the most popular investment asset classes because it will have proven what everyone had said about multifamily being recession resistant. And you could throw that a lot of that was due to government support and other factors, but try to strip out that variable out of any asset class last year.
And that may imply that there is some more room for this to be skewed even further, because if you look at the numbers for 2020, which is on that chart, the sectors don't really change that much. If you, it's on the previous page. Where it measures, one more before then. It talks about the 2020 breakdown, and multifamily in 2020 was 45.9%. Sorry, I have my numbers reported wrong. And 2021 is 42.3%. So it's multifamily investment has a slightly smaller share in 2021 than other shares. It looks like things are still kind of shaking out. I still see a huge leadership role.
Oh yeah, multifamily and industrial for sure. And there's one thing I just, again, because we're looking at this a lot, it's related to kind of the stuff we're targeting. I mentioned this earlier on our Monday meeting, Matt, but how I'm looking at not just for multifamily investment, I'm looking at where are other investments going in that are going to create momentum for multifamily assets. And one particular theme that we've identified, especially in the Midwest, especially in Indianapolis, being the crossroads of America, it's the second largest FedEx hub in the entire world. One of the top airports, Indianapolis International Airport is one of the top airports for cargo freight. Obviously, e-commerce has been growing quite a bit.
Industrial,
is in industrial. Looking at where all these new logistics facilities are being constructed and where those investment dollars are flowing, and you see a very different.
This gave me a little goosebumps
compared to multifamily investment, or retail, or office. It's all of a sudden a bunch of Midwestern markets in logistics space.
Now, for listeners, you got to see this chart. It is the heavy hitters. The Seattles and Phoenixes and Houstons and Las Vegases and South Floridas. Those are the multifamily leaders and the other areas. But when you look at industrial, it is incredible how different it is.
Yeah, it really is. So just on the industrial development list, St. Louis is at number 1. They've grown 144% year over year. And then Sacramento, which makes sense. It's near Los Angeles, but it's a little bit cheaper. Then we've got Austin. Austin's just growing everywhere. Phoenix makes sense. San Diego, Las Vegas, and then Indianapolis, Columbus, Salt Lake City, and Memphis. And so really I'm looking at the St. Louis, the Indy, Columbus, and Memphis that you don't really see elsewhere on this list. And the themes of all of these are logistics and e-commerce for absolutely all of this. I mean, it makes sense. San Diego with the ports, and just Phoenix because they've got a lot of people in.
But yeah, we're looking at maybe a growing Midwestern industrial presence, and those are going to bring jobs, and jobs will bring people.
A lot of jobs.
It'll
People
raise
follow
the
jobs.
economies there.
And decently paying jobs,
Yeah.
too, because they've raised all of those wages significantly. I mean, we see the signs, looking for people to work. I mean,
Yeah.
$25, $35 and, per hour entry level opportunities. And we were driving through some markets, looking at some properties on the south side of Indianapolis, when we were driving by, literally millions of square feet of industrial development under construction. Some just completed, but most of it's still being constructed. And I'm looking around, I'm trying to find all the housing development, because I'm asking myself, where are all these people going to live?
Yeah.
The occupancy in the submarket's like 98%. And I saw a couple single family homes being built, no multifamily being
Well,
in the
and this
pipeline.
is the benefit of having the kind of boots on the ground experience and knowing we've lived through it. We know firsthand, driving by the airport every day, how much FedEx has this presence in Indianapolis specifically. But like, I'm sure that there is a similar story for places like Columbus or Memphis, where maybe they know the individual drivers, but the net result is very robust industrial presence. That's
Exactly. And sometimes they're in parts of the city that you wouldn't have initially identified as like, okay, this is where I want to be, because they're often, slightly more industrial. It's not in the most expensive dirt, because, industrial, you don't need necessarily, main on main location.
Yeah.
But then where are people going to work? Maybe there's not enough housing near there. And sure, people will commute. But, I'm just thinking of one property in particular we're pursuing. Again, there is hundreds of thousands, not millions of square feet of industrial literally going up like right around the street. But if that wasn't there, you may not be pointing to that area, because there are areas that are maybe a little bit more depressed. And if you just drove to the property, you might not realize what was going on. But then you look up at an aerial, and the new aerial photos, Google Earth, they don't even have all the development on there. So even if you're doing Google Earth, you
got to get on the ground.
Got to be on the ground. It really wasn't until you kind of fly over the area you see, wow, this is what's going on. And just as a joke about that specific area on the east side of Indianapolis, I was talking to a broker who had just sold a deal on that side of town. And deals on that side of town often go to a little bit higher cap rates, and you can usually get a deal. He took off on a private jet there's a small airport out on that side of town, literally right next to all this logistics growth. They took off, and they're flying over, and they're looking down at all of this industrial development. And it's so, when you see it, it's so much. And like that, it's like we could have gotten more money for that. We undercut that price. We could have sold it for a lot more, and people aren't seeing it. And again, that's where I think what you said, boots on the ground, is important.
Yeah.
How else do you know?
Zillow, I keep coming back. That's
Zillow.
My straw man. But they tried to, put an algorithm to it. There's just so much information, and it is information that you'll get through lived experience and just knowing what's going on.
Yeah. Absolutely, Matt. Well, so this is a great report. Again, you can find these reports on the Gray Report. Sign up for the Gray Report newsletter, graycapitalllc.com/newsletter, or just hop on over to grayreport.com to get daily updates. Let's move on to this Newmark report. It's another capital markets report. So again, we love comparing these different reports covering the same topics to see what is the difference.
I liked this report. This was a good one, actually. Kind of some bold calls in it. That's good. And yeah, I'm happy. It makes me, I like reading this kind of stuff. So slightly different numbers for multifamily investment, but still within the same ballpark as the CBRE capital markets report. CBRE had had 315 billion for multifamily last year, and Newmark has 335. And the quarterly numbers is also roughly the same. Returns, though, this one really does look at returns in a little bit more detail than the CBRE report. They increased to their highest level since 2005, which is 19.9, more than double the long-term average of 8.6. Absorption continued to outpace supply at 673,478 versus 358,734 units.
So we were close on that double, right?
Yeah. Oh, and this is, and again, like this is the context that we're talking about. If those numbers were flip flop, then we may be looking at a problem. But all of the absorption numbers seem to be going up. All the vacant, or at least stably high, and all of the vacancy numbers have been fairly stably low. So I don't think that there's going to be a housing crisis coming soon, at least if you're looking at supply and demand.
Well, again, this is interesting because people point to the markets that housing experts, at least, seem to say they're the best markets because they have all the demand. They're looking at the demand, but I would say people who are casual observers only looking at the supply and saying that's a lot. That's a big number, and it was more than 2008. And I'm just going. We're at that peak, and so therefore things must go down, which is a relatively lazy analysis.
Population growth? I don't know.
Not that again. I do think there is a concern for oversupply. And I think that the chance of that happening would be in those markets that are having an incredible amount of supply.
Yeah.
Now, the demand seems to be there.
Yeah.
You can find markets that have a little more balance where we're seeing incredible demand without the supply. That's what we've been targeting.
Yeah,
but I still don't think
well, and that's the thing. It's like we've been very, I would say is optimistic about the growth of the housing market and multifamily specifically. But at the same time, we are sensitive. That's the first thing we look at when we're looking at markets, or one of the first things is the supply. And so as long as you're sensitive to that and you're aware of it, then it's not going to be that risky. You're not going to have to worry about all of a sudden there's twice as many houses on the market than before.
Well, that's what these people have been talking about, which we'll do. We're going to do a reaction video. So again, we're looking at a graph. If you're a listener, of just looking at sales volumes, 2001 all the way through 2021, and there was.
There's your base effect.
That's quite a bit. Exactly. So in 2020, sales volumes dropped to 146.9 billion, I assume. Yeah. And then back in 2019, though, we were at 193 billion, and now it has increased ever since 2009. But in 2022, we had a record at 335.
Yeah, and it looks like the 2021 numbers, they more than make up. So it went from, in 2019, investment numbers were 193 billion. Then it went down to basically 147 billion. But then in 2021, it's 335 billion, which is vastly more than the difference between 2019 and 2020.
Oh yeah.
It's not like it's making up.
We made up for it. And so what are the reasons?
And more.
And so what were the reasons for this? There's a handful. One, and this is a trend that's going to be going on for the next couple of years. It's a generational thing. It's related to the Great Resignation, but there are owners, a lot of apartment owners they're getting older and they're wanting to retire.
Yeah, that's a good point.
And they're like, I'm trying to sell my assets, take a more passive approach, just simplify things. And because now they're able to, they're getting called from brokers every single day. They were last year and they still are today, saying, ring, ring, your asset that you bought for $4 million is worth $20 million.
Yeah.
And in their mind, they never thought that they would see those valuations. And then on top of that, last year, there was all these conversations of, increasing capital gains tax, all these discussions on changing the tax code, and that created a lot of uncertainty. And for a lot of investors, let's lock in the tax rate of today rather than roll the dice on seeing what's going to happen over the next years. That pushed a lot of sales forward. Then you said, the pandemic in 2020, there weren't as much sales. Some sales were just delayed and bled into 2021. And so there's this confluence of factors. On top of multifamily is doing really well.
Yeah.
We said back in 2020, it's in a recession, it's doing really well. All these other investors in retail and office, hospitality, aren't exactly rushing to go buy another hotel.
Yeah.
Where are you going to put your money? Want to invest in real estate? Multifamily seems pretty attractive.
Yeah, there definitely is more investment attention, I think, into CRE and multifamily for sure.
Yeah, but man, just looking at these monthly sales volumes, just definitely aggressive, and that's where, again, if you're just looking at charts and with the idea that what goes up must go down, and there's always a reversion to the mean and all of that, then you're like, yeah, this looks like a kind of a parabolic move that should have some sort of correction. And I don't think that's like a inappropriate, a reaction, but I think it's what is causing this to happen, and a little pullback. That may be okay if that was even to be the case.
Yeah, I think I also like their information on returns. If I could, kind of return to that. On page 10, it looks at the returns by market, and I think it's kind of interesting because we've looked at rent growth for a lot of these, but these factor in appreciation as well as as well as kind of the total return that they have, and we see some leaders. And these are clear leaders, that we've covered before, but it is worth looking at how much appreciation has really skyrocketed over the past year. And Las Vegas and Phoenix up almost 90% in terms of just appreciation,
because they got the rent growth and massive cap rate compression.
Yeah,
so they're hitting on all cylinders.
So they're on the far upper right, which is where you want to be, and Chicago is down there at the bottom end with less than 10% of total return for the past year. A lot of growth.
Wow. Yeah. That's incredible. And then let's look at this dry powder, because again, this is true in the multifamily market. It's true in the single family market. And again, this is theme of talking about, comparing a crash and what would lead to that. There's so many buyers that are lined up, haven't been able to buy deals, haven't been able to buy apartments, haven't been able to buy houses. If there is a price drop, you'd assume that there would be some of those buyers. Some of them will go. Yeah. That would still be there. Some would go away, but some people get very fearful, and the fear that led them to not invest maybe last year or 2020 is probably going to lead them to not invest in a drop. But there is so much capital earmarked for commercial real estate, especially multifamily, because where else are you going to go? Everything's this kind of conversation of apartments seem expensive. Show me the asset class that isn't right now, that you're saying that this is like a really cheap, and it's not a value trap.
It is interesting that they are looking at opportunistic by far. This is their biggest, they're searching for deals, it seems like.
Yeah. We're trying to find an out. Yeah.
And it's almost like, I don't know, because looking at the graph of dry powder, it has increased. There's a steady increase each year, it seems like, by about, so now it's 249 billion, and last year it was 229 billion, and the year before it was 211 billion, and so on. So it's not like there's a big jump in dry powder. I wonder if these people are going to be still looking. It's not like this money's going to instantly flood the market.
It's trying to. They can't find deals. I mean, I'm having conversations every single day with people who are trying to place significant pieces of capital. I mean, I had a call yesterday with a group, and they're like, can we take 30, 40 million?
Okay.
I was like, I thought that their range was kind of the 5 to 10. They're like 15, 25. I'm like, okay.
And see, I don't know. And I agree. I think that's more accurate. And this is just speculation, but it seems like looking at opportunistic, are they looking for, this miracle deal that'll never, this opportunity?
Yeah. Well, and that happened a lot earlier in the pandemic. I was having a lot of conversations with people who were like, they were starting opportunistic funds, or they're like, we're going to be very opportunistic. And for the longest time, it's like, we're waiting for this COVID pricing to come in.
Yeah.
And they're like, are you seeing any discounts? We're hoping. and some properties that were like in the market early in COVID, it was like a 5% discount, maybe. And just for people who were like had to sell. Yeah. And all these groups were like, we're waiting for it to drop. We're waiting for it to drop while we are buying real estate. And it never happened. So they raised all this money waiting for this crash, and never happened. And then they were playing catch up because they're like, oh, that didn't happen. Things actually look really good. Yeah. They make a quick switch, and now they're trying to buy. But they're late to the game. They're playing catch up.
Yeah. If we can skip ahead to page 19, actually. So if you look on further in this report, it has the information on the price per unit. Now, I think that this is a useful metric that can help when assessing individual property acquisitions. Now, Class A apartments are obviously going to be priced differently than workforce housing, but on average in the U.S., the price per unit is $238,000. It's $353,000 for major markets and $238,000 for non-major markets. So you see the non-major markets are really an outsized portion of the U.S. average. It's really bringing it fairly close.
That makes sense.
But I think that it's interesting how much It has risen in the past year, but it's still, if you're looking at price per unit, it seems to have dipped down pretty dramatically in 2020, and it's coming right back up to its previous peak.
Yeah, that can be tough because, it's like what type of properties were sold. If it's an older property built in the 60s, it's going to obviously trade, it could trade half the price of a newly built project. I mean, there's stuff on the market right now for, well, not a whole lot for under 100K a door, but let's say 100K a door, and there's stuff on the market for 250, 300K a door in the Midwest.
But I think that this is a good starting point when you're trying to look at the relative performance or what you should expect for a individual property. Everyone, the amount of units in an apartment building is not standard, and so knowing the price per unit is a nice little
the price per pound, price per unit is definitely a good barometer. It sometimes it's more appropriate than others, but 100%. So this is breaking down, which markets grew by how much, kind of putting them into a couple different categories you may call, what's kind of, stable growth, what's high flying growth, and what's just really lagging behind. And so let's look at some of these markets. Markets that grew by 0% to 0.5%. Madison, Wisconsin, Minneapolis, Fargo, Midland, Odessa, Youngstown, and Champaign. All markets that we are within our operational range, but we've decided to not enter those markets.
Now, this is really interesting because their average for the year in 2021 is among 16. The lowest.
Or what's Newmark's average?
6.8% for 2021. That was how much they think rent grew in 2021. That's lower than some of the lower, maybe the lowest that I recall.
Okay, yeah. See, I thought that, and let's just, I thought that they had rent growth at 16%.
That was for the quarter. Annualized rent growth averaged 6.8 for the year.
Well, and just so we're talking apples to apples, effective rent, not market rent.
Now that's a good point.
That is accurate. And 6.8% effective rent is huge. Market rent is what we've seen growing to double digits.
And so that explains what I think was another weird part of this. And I thought it was a bold prediction, but it may be a more clear-eyed view of what investors can expect in terms of returns. Their forecast for rent growth in 2022 is 12%. It's almost like a flip-flop of expectations.
Well, but to me that makes sense for this reason, and we've been talking about this, is the spread between effective rents and current market rents, and what is the difference? Because if effective rents are the average rent that people at a property are paying. Yeah. The leases that were signed last year, renewals, leases that aren't raised as much, but they're not always brought to market. So that's going to be an actual accurate number of what people are paying today. Market rent is just something that someone has posted online somewhere that they are attempting to lease an apartment for. And so they could never even achieve that. They may have only rented one unit. And so if you're looking at market rent growth on a property, they raise the rents $200 from $1,000 to $1,200. You see, there's a 20% market rent growth. Yeah. But and they've only signed one lease, so the effective rent growth is, I don't know the math off the top of my head, but it's probably 1% or so. It's a fraction. It's not even 1% over the total average leases. And so over the next year, I think 2 to 3 years, because that's about what it's going to take to get through renewals. 2 years at the earliest, and then a little bit of growth in year 3. Take all future organic rent growth out. There's going to be this growth of the effective rents gradually moving up to market. Yeah. As people finally move out, they turn those units over, and because they'll probably still have a couple units at $1,000, and then they'll tag on $1,025. Yeah. But then they're like, okay, you moved out, now the rent is $1,200, and that's going to happen over a couple of years. So that's the difference.
Yeah, it seems like now the market still is priced based on market rent instead of effective rent. Like they're already kind of assuming that.
You're paying up. Yeah, you're paying on pro forma for sure. 100%. Yeah, where do you want to go to next?
If we
Matt?
can move on to the apartment list report, actually. So the top line message for this report is that on-site workers are paying markedly more, and they are markedly more cost burdened than remote workers when it comes to rent.
And on-site workers just means someone who works like at somewhere, like at a location, not out of their house.
Yeah, that is not able to do remote work. But I think this isn't too surprising, but it's fairly interesting. The places where remote friendly occupations are most common, where they have the most remote workers,
like a San Francisco,
those places the rent growth has gone not as high. The places where they have a lot of people that are working on site, those rents have gone up.
And that's interesting. There's a lot of things we can compare to or causes. That
I think that it is a little
San Francisco bring that number down, you think? You just because it's such a large market, and San Francisco has just been suffering so much.
Well, and that's the thing is like, and I'll get into this a little bit. They don't provide 100% context here. And it's also interesting how narrow of a band we're looking at. And if you scroll down, they have a little bit of a chart here. The amount of remote friendly jobs seems to be hovering around 30 to 40% for most of these cities, rarely under 25% or above 40%. That being said, barring the possibility that they cherry pick their cities here to make their point, apartment list draws up a pretty sharp correlation here.
Describe what we're looking at, Matt.
Yeah, so we've got a scatter plot here where it has Riverside, California, on the top left, where we're seeing a lot of rent growth and very few remote friendly workers.
So on the far to the left of the graph is not remote friendly. To the right is remote friendly. So you'll see San Francisco, that's the top right. Places on the left are Riverside and kind of a Louisville and more Midwestern markets, I would guess.
Yeah.
And then the y-axis, rent growth, 2020 through 2022.
Yeah. So it is a fair, there is a band. Like I said, it's like 30 to 40% is usually what you're going to see in terms of how many remote friendly jobs are out there per market. Mm-hmm. But that being said, you got that San Bernardino Riverside market with 32% and 23% remote friendly jobs. And then there's San Jose, San Francisco, the other two Sans on the other end with 46% remote friendly jobs and 42%, and then both of them negative 7% rent growth. So these places where you think that they have all these remote workers and they must be, doing well and increasing rents, their rents have gone down.
People are leaving.
That could be a case. I
mean, Washington, D.C. people aren't leaving. San Francisco, they are. Minneapolis, they are.
So here's a quote that
Denver,
I think
they're not.
kind of
Boston,
hints.
They're not.
So this quote kind of hints at what I think might be going on. It says, for instance, it can be seen that some of the areas that had the lowest cost burden rates for on-site workers before the pandemic have actually seen some of the region's fastest rent growth over the past 2 years. Low rents pre-pandemic, they had a chance to move up. They had more room to move up. The pandemic has had a huge leveling effect on housing costs and rents, so you would expect that those places with lower costs would be the ones to see this increase. Again, I kind of hinted this. It's a little bit frustrating to read reports like this that call attention to what are pretty compelling trends without fully accounting for the context from which these trends have emerged. If you skim this report, it does little more than leave you with the impression that on-site workers have it harder than remote workers. I'm not going to argue about that, and rising rents are exacerbating income inequality, which may or may not be true, but these impressions are full of implications and assumptions in and of themselves. And without examining why these trends, specifically rent growth, have emerged, it's difficult to imagine a solution, which fortunately, that's why we're here. Spencer, I've got a solution.
Good.
I wrote it down.
What do you got?
So, okay, let's start.
Everyone's trying to figure out. So, what's the solution?
Let's start with San Bernardino. And let me tell you right now, I don't think you would have thought of this. So let's take rents in San Bernardino. Let's say cap the rent increases at 5% plus the percentage change in the cost of living, or 10%, whichever is lower of the lowest gross rental rate charged for that dwelling or unit at any time during the 12 months prior to the effective date of the increase. It's pretty simple.
I don't like what you're saying, Matt.
Well, I do have to admit something. I didn't come up with that idea. That's actually California Law AB 1482, otherwise known as the Tenant Protection Act of 2019. I'll figure out something in the meantime. I'll figure out a way for the government to reach into the market and set things right.
It didn't fix the problem.
Doesn't look like it did. Now, this law seemed to have gone into effect in August 2021, but if rent control laws and the word of mouth about them have any effect on investment in an area,
well, it started in LA, and then
well, but if this is the law of 2019 and that has made investment shy away from places like San Bernardino, then there's 2 years of maybe higher supply that they could have had on there. What I really think is happening is the places with a lot of remote workers, a lot of tech workers had high rents anyways. And so that's why they cooled off. That's the story. It's not a story of, these people are being squeezed even more. That may be the effect, but the real story is the cheaper places to live had more to catch up on, and the more expensive places to live were cooling off. So that's my sum.
I think that's a good summary. I think it makes sense. Hop on to grayreport.com if you want to actually take a look at these reports. Because again, a lot of great data sets, some good visualizations, especially if you're listening to the podcast. And you can watch a recording of this conversation of the Gray Report on YouTube. Hop on over to our YouTube channel, and we're sharing these graphs and screens. But if you actually want to get the reports yourself, grayreport.com, or sign up for the Gray Report newsletter. Matt, let's move quickly just over to the Wall Street Journal article, just briefly talking about investors' sentiment. Investors are buying real estate in the Sun Belt. They are?
Yeah, exactly. I was so shocked. I was like, what?
But, Wall Street Journal listener, they're they may not be focused on
exactly. And this is I like to read these reports from the quote unquote mainstream news or these larger news outlets. They're talking to the layperson. Specifically for Wall Street Journal, it's probably a business minded, they're business minded readers, and they want to clue in on the multifamily market. And so this is how they characterize it. Basically, they say that one thing that's pulling people to the Sun Belt markets is rising wages, including the demand from higher paid workers moving into Florida and looking for apartments. That looks like it makes sense to me. I do think it's interesting, and it's just as anecdotal, but it talks about how one company's portfolio went from 2% pre-pandemic to 20% in the Sun Belt post-pandemic.
Oh, yeah.
Now, we saw the exact numbers from the capital markets report that we just covered, but 2 to 20%, that's a lot. So that's a really telling story and, kind of a specific example there. Another thing that they see as drawing people to places in the Sun Belt is expansion of university campuses and medical facilities that attract knowledge workers, as well as new investments in transportation infrastructure, specifically in Phoenix. Again, alongside the rising wages you look for when you're doing your market analysis, you look for stable, robust jobs. And I think there's a reason why, universities are called institutions. They're not going anywhere. I think it's a little risky when you're relying on just the hospital and just the university for employment.
Yeah, you want some other stuff going on.
Yeah. And then finally, as I mentioned in my thought experiment with San Bernardino, it does talk about a little bit of pushback, and I wonder if these voices are going to get louder. It said the frenzy in the multifamily market, intensifying concerns about affordability, and lawmakers in Tampa have discussed rent control. The U.S. Senate Banking Committee held a hearing to discuss the effects institutional investors are having on housing affordability. I think that there are, the following quote is, but for now, there appear to be few threats to these billions in new investments. There's billions on one side, and then there's some kind of preliminary conversations on the other. I don't think anything's happening necessarily on the government side that anyone's scared of.
But what the risk in the political risk is some knee-jerk reaction from politicians who don't understand economics, who are just making, again, taking politically convenient stances. In really populist stances, because it's easy to say you can get to someone's heartstrings immediately. Talking about their wallet, and everyone's seen prices of everything going up. And that's why the conversation of inflation is powerful, and the Republicans are using that, and then the Democrats on the local city council side, they're going to be using it to say we need to we need to put in place price controls, which rent control is price controls.
They see this problem, and it doesn't even matter if it works as long as you're doing something.
Yeah, it doesn't matter. It doesn't need to work. We have to just feel good that we've done something.
Exactly.
To get reelected.
And it is, And it is true. Like, I think that's almost like a fundamental truism for politics.
And so these markets that are high flying, you may not be the supply issue, but another risk factor is the overreaction to the inflow of residents. And so a market like Tampa, he would not, and I'm not an expert in Tampa politics, but it wouldn't strike me as the top city that would implement rent control.
Yeah.
But when you see rental rates increasing by 30, 40, 50%, if a constituent comes to you and is like, is this right? It's hard for you to say it is. And then and again, it's a slippery slope. Well, that's unreasonable. So we will have a cap of 10% or 15%. That seems reasonable, but then, that cap gets lowered over time and it just distorts the market.
Again, and we have talked about rent control. I think the 6.8 on effective rents, that's the number that may be, it's what people feel. So the effective rents, what people feel.
Exactly.
Once those really start going up, and if they go up by 12%, we're going to hear a lot more about this. It's milk and cheese today, but it's going to be rents in the future.
The buzzword that I've heard, I've seen it quite a bit on Reddit recently, is the renoviction phrase of, and we don't, basically it's the idea, according to the renter, is like a buyer comes in and they basically try to evict everyone. If they can, which usually you can't. But basically, or buying people out of their leases, obviously doing a value add plan, renovating the units, and then raising rents significantly higher, and really pushing into residents are like, you're going to kick me out of my home. I've been living here. Now you're saying
that seems like a tale as old as time almost. And I don't see that as a big threat. But
the bottom line is it's becoming more and more talked about. And the political risk is definitely out there. It's more so in some markets than others. I don't see how anything happens federally. I just don't. I mean, I don't see how that is applicable or constitutional. But
you've mentioned there are some investors. There are some liberal Democrat investors in commercial real estate.
Exactly, and if you start looking at any kind of economics textbook of anyone, there's not really
and that's what you were saying too. It's like
on the side of
there's a political thing, but I think also they would be fools to not consider that there's going to be economic consequences, and it's hard to upset the boat without knowing what's going to happen.
I agree. All right, well, this is a great episode of The Gray Report. I appreciate you either watching or listening to The Gray Report. You may not know that you can subscribe to the Gray Report podcast on Spotify, Apple Podcasts, Google Podcasts, and something that would mean incredible amount to both Matt, myself, the entire Gray Capital team is leave us a 5-star rating and a review. But also don't forget, you can go to the OG spot for the Gray Report, and that would be on the Gray Capital YouTube channel. Make sure you're subscribed over there on YouTube. And to get the trifecta, hop on over to graycapitalllc.com/newsletter. Make sure you are signed up for the Gray Report newsletter. And so once you have that holy trinity of Gray Capital, Gray Report information, you're going to be ready to take the next step with the Gray Fund. Again, it's only open for accredited investors, but we're going to be buying around 7 to 10 cash-flowing multifamily assets in the Midwest, markets that we've identified just have incredible drivers, the right supply and demand fundamentals. We have boots on the ground experience and the operational capacity to execute these business plans. Again, the timing is right. And if it stops being the case, we're going to know about it because we're checking these reports every single day and every single week. So hop on over to graycapitalllc.com/grayfund for more information on how you can subscribe and be a member of the Gray Fund. Only open to accredited investors. This is not an offer to invest in any securities. Any such offering will be in the form of a private placement memorandum. Love to see you next week. Get in touch with us. See you on the next Gray Report.